This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Dougal Cameron of Golden Section Ventures. Dougal, thank you for joining us.
Thank you, Hall.
So can you tell us a little bit about your background before joining Golden Section Ventures? What did you do before this?
Yeah, before Golden Section, I worked in manufacturing and other areas of private equity. I actually started my career at the Federal Reserve Bank doing economic analysis and supporting a couple of the vice presidents with their own research and their internal strategic initiatives. And so I've been around economic research and analysis for a long time. I ended up pursuing and getting the CFA designation and early on in my career. Initially, I thought I would pursue a job in equity research or some form of investment management. And those pursuits and my family's long history in entrepreneurship really drove me to focus on software as an asset category. And then that eventually brought me into running a couple of software companies, starting up a few, and helping them on their path to grow and exit. And that journey gave me and my partners a lot of conviction on how these companies ought to be grown, and in the process to see value created in the enterprise B2B software space.
Great. So you work in the B2B sector itself. What's your advice for people investing in this sector?
Yeah, so we see a lot of investment in this sector from people that like the returns that they hear about, and they also like the things that they read about the sector. And that's, I guess, inherently going to suffer from selection bias. And as a result, we see a lot of people gravitate towards the shiny investment things in the B2B SaaS space. So something that maybe sounds sexy or is the topic of a lot of Wall Street Journal articles or whatever it might be. Maybe there's a charismatic team leading a cool big buzzword idea. And they make an investment without understanding the fundamentals of how a software business creates money and builds value. And we think that's something that people should avoid doing. And we try our best to educate investors in our network on how we believe value is created in the B2B SaaS space. Because a lot of times these companies can be forced to grow or maybe expected to grow faster than they actually can grow. And that leads to a bunch of problems. And so I think one area of advice is to be careful about investing in shiny things. The second area of advice is to make sure that the investment structure aligns with the incentives of who you're investing in. And so there's kind of two edges of the knife that you don't want to fall off of. And I know we've talked about this in the past, but you don't want to have a minority position in a company that becomes a lifestyle business. B2B SaaS companies are really stable revenue businesses. And so if they get into the $2 to $4 or maybe $5 million revenue range and they're not growing extraordinarily fast, they might not be a good fit for a future venture round. And you as an investor might be trapped as a minority, having a minority position in what becomes a lifestyle company. Obviously, nobody investing wants to be in that position because there's not a good exit opportunity. The second side of that equation is you don't want to have a structure that's so onerous that blocks additional accretive investors from joining to help the business grow. And so it's kind of a blend of both of those things. You want your structure to be aligned with the entrepreneurs that are running the business to ensure that they get you to an exit. And that might be a future venture round where you have more institutional money driving to an exit, or it might be to a bootstrapped exit to a strategic, which is more of our model.
Great. So how do you see the B2B SaaS sector evolving as an industry? What kind of growth rates do you see coming up, and where do you think it's going?
Yeah, great question. I think the industry is maturing by and large. The software industry it's no longer a surprise to see a software product works and provides value and can be something that a business can bill customers for. However, it's still being treated like that's a key risk. Like bringing a product to the market is a huge challenge. There are a lot of challenges, obviously, to fitting a product with the market, but those challenges have more to do with the business model and whether and to what degree the product is needed versus that it's somehow inherently difficult to build software. And that's obviously not the case in a lot of venture categories like biotech and other things where there is a technology production risk. I think the technology production risk in software is more muted, which means that the traditional venture playbook might not be the right playbook for all B2B SaaS. So I think what we're seeing is a trend towards money that's typically been available to in other industries that aren't ultra high growth for early stage bootstrapped founders to get their company into kind of a self-sustaining mode. And I think the industry is moving towards adopting more of those models, whether that's recurring revenue-based lending facilities like Recurring Capital in Austin or others such similar revenue-based lending groups that provide bootstrapping founders an alternative to a venture model. I think groups like us popping up, we're more of a software equity fund for bootstrapped founders than we are a traditional venture approach because our playbook is, I'd say, completely different from typical venture. And so I think that's how we're seeing this industry evolve. And then within the company space, that's really on the capital side. Within the company space, we're seeing more and more point solutions being tied together through web services to add value and hold to the end customer. And we're seeing larger corporations and larger sort of software buyers and customers take a best-in-breed approach to tying together best-in-breed point solutions rather than relying upon an SAP or an F4 or a ERP that they're using to be a one-size-fits-all solution for their entire company. And I think that trend's going to continue, which means that the scale of companies can get smaller and still have a great exit. And so that's a trend that we're seeing.
Well, how many companies are engaged in this sector overall? It seems like it's quite big.
Yeah, I think it's very large. I guess I don't know the number right off the top of my head, but I think it's tens of thousands of companies in this space.
Wow, that's quite a bit. That's great. And so, continue on with your current thought.
Yeah, so my thought is that the growth rate in this space is going to be, I think it's going to be stimulated a lot because of coronavirus in the sort of post-COVID world. We're seeing that in our portfolio, and we're seeing that in prospects that we've been talking to for a while and monitoring their growth rate to see whether or not we're a good fit to make an investment. And I think for the last 10 years, we've had just, I guess, a general lack of tech adoption by most technology consumers because of a 10-year expansion. So this 10-year prior expansion that ended in February caused complacency in a lot of businesses because they didn't have to adopt technology solutions to compete in the marketplace. And now in the post-coronavirus world, we're having to figure out how to operate teams remotely. We're having to figure out how to serve their clients remotely. A whole lot of tech adoption catalyst events just happened all at once. And you'll read a whole bunch of different estimates of how many years of tech adoption just got shaved off the roadmap. But we think it's pretty significant. And so that's going to impact the growth rate, I think, pretty significantly to this industry. And that's also going to cause a lot of companies to buy the wrong solution, which means that the future growth rate won't necessarily be impaired for companies that are operating in the space and have a clean, crisp ROI and a good product market fit.
Well, it sounds like a great industry segment. What are the challenges in this space to those who are running SaaS businesses? What do they have to overcome in order to be successful?
I think the primary challenge is that they need to understand what's the appropriate growth rate for their company. And so we see more companies that try to grow faster than they can grow than we do the opposite. And the reason for that is the traditional venture playbook of sort of rapid market grabbing. It can work in a very easy to install point solution, but a point solution that has a sales rep led sales structure just is not going to be able to grow near as quick. You can still achieve 100 to 200% growth rates per year, but the doing silly things with the money that you've raised to try to get a growth rate artificially is, we think, a bad move. And so there's a pretty big challenge right now to right-sizing the growth rate and sales organization within the company. That's kind of an ongoing challenge. I think another challenge is to communicate the type of growth rate that you want as a founder and a founding team and attract capital that's going to be okay with that. Because there's really two different pressures that most venture firms feel. the first pressure is to find good deals to make investments in, and the second pressure is to deploy capital. And sometimes that results in a venture firm wanting to deploy more capital into a company than that company might need. And and there's this kind of, I guess, expectation in the market, perhaps driven by selection bias, where you're only hearing about the successes, to continue to receive venture funding when it's available. And and that might not be the right move for a lot of companies, because we believe the right exit is between 5 and 15 million in revenue for the vast majority of B2B SaaS companies. And so if a company gets into that exit window and then there's an opportunity to sell, but the capital stack is excessive relative to the amount of revenue that they have, then there's not going to be an opportunity to sell it, because that founder is not going to hit their venture partner's exit goals. And, and so that's going to result in the challenge just based on a liquidity preference. So we think that that's a challenge. Founders understanding incentives, from the capital that's chasing them. We think there's also challenges right now in taking advantage of what we believe is a big opportunity for B2B SaaS companies to pick up great talent and to expand their customer base, because right now there's a lot of access to customers that's unusual. And the temptation right now, if you're an operator, and I feel this too within Golden Section, is to pull back and skinny down the organization and cut costs where possible to be conservative, when the right call might be to expand. And obviously everyone needs to make that call for themselves. But I think that's a big challenge right now, is that we're seeing in our portfolio and with our client base a pretty dramatic reduction in acquisition costs and access to customers like they've never had before. And so in the face of that, if you pull back and you miss that opportunity, it might not ever come back again. And so we think that a challenge right now is to push against what certainly is conventional wisdom, but what will definitely be personal kind of fear, is to push against that and to see whether or not that thesis is working for somebody's firm. And if it isn't working, obviously the advice would be to not continue to push forward. If it is working, though, we think that there's an opportunity to expand the businesses dramatically right now. So managing that tension, I think, is a big challenge.
I see. So how does Golden Section Ventures fit into this overall B2B SaaS landscape? What exactly do you guys do, and how do you do it?
Yeah, great question. So we are a software equity fund. We help founders get to the sweet spot of 5 to 15 million. And our goal is to get founders 80% or more of their business at the final exit. And because we've been founders in the past, we've done it the right way a few times and the wrong way a few times. And so we like to help founders avoid the big pitfalls that we experienced or that we saw people experience, so that they can get to a really healthy exit and have a windfall for themselves and their families and their employees that is incredible. And so we want to see that happen. We help founders on that journey, and we believe that our fit in the marketplace is helping a founder at about $1 million in revenue, maybe a little bit more, get to the $5 to $15 million revenue threshold with about 50% of the amount of capital than the rest of the world uses to get to that same revenue threshold. And that sales efficiency ratio advantage that we can bring to the table is because we've sold $350 million of software ourselves. We've been founders before. And then also we have some advantages on the tech side, where we can help drive 30 to 40% more output per dollar of tech spend than most people are going to experience on their own. So because of that, we can parlay that extra money into the sales and marketing spend and help drive an exponential benefit to the growth rate. And so we fit in the landscape really by helping founders get to that $5 to $15 million threshold. And then when they get to that threshold, making sure that their company looks beautiful and is ready to sell. And we think that's how you maximize your dollar per unit of effort. And so that's how we fit into the ecosystem.
Well, great. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
I think one thing, and I've talked about this a little bit through our talk today, is what we're seeing in the marketplace and some research we did recently. We went and analyzed the 1918 flu pandemic and the economic fallout thereafter. We also analyzed the 2008, 2009 economic recession to get an understanding for what we might be going into with this coronavirus COVID-19 era recessionary world that's really global in nature and not specific to any particular country. In addition, we wanted to ask, what does B2B SaaS do in that type of a recessionary environment? And what we found was the 1918 flu pandemic resulted in a pretty short recession. It was about a 7-month recession. Revenue pullback was dramatic, pretty similar to what we're seeing today. The most impacted industries similar to today were retail and restaurants and other kind of in-person transactional types of businesses. The businesses that persisted were more subscription in nature. So like whether it was long-term rate frail contracts or something like that, freight rail contracts or things like that, or it was other sort of subscription, news subscription type of businesses in 1918. In 2008, 2009, I think that's a better indication of how SaaS operates in a recession. And that downturn was 18 months from peak to trough. We believe that downturn we're going into is going to be about 11 months, maybe a little bit more to trough. It's going to be more than the 1918, less than 2008, 2009. That's kind of our shooting off the hip estimate. That's what we're operating on. But what SaaS companies do that we think is really interesting is in the 08, 09 downturn, all the publicly traded SaaS companies continued to grow through the downturn. Their growth rate slowed down from 50 to 10%, and their profitability increased from negative 10 to positive 6% on the whole and on average. If you go down and look at an individual company approach, only 2 out of the, I think, 18 publicly traded companies at the time saw a reduction in revenue, and they effectively just treaded water for 2 quarters. So those firms continue to grow. And so our question when we looked at that data, and as operators back operated companies during that time period as well, we asked, why did growth rate reduce when profitability increased? And we think that those two things are linked. So we think the reason growth rate reduced is that companies pulled back on their sales and marketing spend. If that's indeed the case, then our next question was that the right move, or should operators operating on a general fear instead of a specific fear of their company? And should they have increased expenses during that time period and perhaps leaned into what would have been a growth advantage? We went and looked at Athena Health, Salesforce, and Success Factors, and virtually every other public company that was trading at the time to get an idea of what their sales efficiency ratio or their acquisition cost did during that downturn. And relative to 2010, the 2008 data and metrics were about 40 to 60% advantage. So that meant that relative to 2010, spending $1 of sales and marketing in 2008 would have picked up 1.8 to 2.2 times more benefit than that same dollar spent in 2010. And so that's an unbelievable advantage if you're trying to grow a B2B SaaS company. We think there's a kind of a compound series of reasons behind that. The first reason is that firms are looking for cost savings during a downturn. Second reason is that the primary competitor you're fighting against when you're selling B2B SaaS is do nothing and status quo. Most businesses want to continue to do nothing and they want status quo. And so you're trying to convince them off of that position. And during an expansion, operators are less likely to take risks like installing a new system because what's working is already working and they're producing good profits. So why rock the boat? During a recession, firms are looking for competitive advantages to remain afloat and try to get back the business that they're losing. And so we think that that's a big instigator for why acquisition cost drops during a downturn. So it might be the case that the sales process increases or lengthens a little bit, but what we do know is that the acquisition cost to get that customer all in drops dramatically. And so since that's the case, and since that happened in 08 or 09, we think it's also happening right now as firms are looking to adopt technology at a much faster rate than they were in the past. And so therefore, our belief is that B2B SaaS founders and teams ought to be testing out expansion strategies right now to see if that thesis is working for them. And if it is, they really ought to double down and grow through this downturn. Because coming out the other end, while all their competitors are going to be blaming bad growth rates on coronavirus and on a weak recessionary environment, they are going to be blaming a relatively high growth rate on the same thing, which is going to be a great position to be in to either exit or to get a great Series A or Series B valuation. So we think that the opportunity is worth testing that out. We don't think anyone should just blindly expand their sales and marketing budget based on our word alone, including our portfolio. We're asking them to do tests to prove that out. And so that's something we're really excited about. And for all of your listeners and for all of our portfolio and our clients, we're asking people to reach out and let us know what they're experiencing and what they're seeing, and we'll share our thoughts as well, because we think the entire industry as a whole, particularly in the small company space at 10 million in revenue and under, we think that those businesses could be entering a golden age of SaaS selling. And if that's the case, we obviously want to help everybody go and execute on that, because the venture industry, B2B SaaS industry is really an all boats rise in a rising tide sort of a situation. So we think the more companies that can execute upon this, the more customers are going to see ROI benefit, the more adoption is going to be in general to SaaS as a category.
Well, that's great. Well, appreciate you sharing that with us today about the B2B SaaS sector, as well as your view of the COVID pandemic and how best for listeners to get back in touch with you.
Great question. I am reachable on LinkedIn is probably the best platform to reach me, and we'll have the link, I think, in the show notes. They can also come check us out on our website, gstdev or gstvc.com. And if they Google my name, Dougal Cameron, they'll find myself or my dad. So they've got a 50% shot of finding me. And there's not a whole lot of Dougals out there. So happy to engage with anybody that has kind of thought on the sector or would like to know more or has some data to share, and obviously reciprocate.
Great. We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you, Hall. Appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall in podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.